Hey everybody, Tchaikovsky here. Hope you guys are all doing well. This is something I went through and did in my intermediate accounting class this past Wednesday. Is we did zero interest bearing installment notes. So I'm going to kind of like tweak a little bit of when it's essentially it's a zero interest bearing note, but instead of in a lump sum, it's going to basically be paid in installments. So let's go ahead and just give you my typical disclaimer and copyright notice. The information and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College of the South Orange County Community College District. The presentation is for educational purposes only, does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will be making reference to publicly available information as the copyright of other parties. I do not claim any right to the copyright of those third parties. Perfect. All right. So now we're going to kind of look at this in the earlier question we did was like, well, what if you have a zero interest bearing note that's being paid 4 years from now? But what if in fact, what if it was in installments, right? What if you had, say, $1 million note and then over here you had this $1 million note and now you're kind of saying, well, it's $1 million note, but when it comes to instead of being paid all at once at the end of 4 years, what if it in fact is 250,000 per year? So let's go ahead and kind of take a look at this, right? Um, so, so let's go ahead and copy and paste. Okay. So let's go ahead and basically go ahead and start in on this note. So Freddie Jason purchased equipment on 1/1/22 by issuing a note for $1 million due on 12/31/25. The note does not bear interest and the fair value of the equipment is not readily determinable. For FGI, the market interest rate for a similar note is 8%. I changed that from the other question. The equipment is estimated to last for 6 years with no basically with no salvage value. I record any interest expense using the effective interest method for any discounts. And no will be repaid in installments uh, of $250,000 each year on 12/31/22, 23, 24, and 25. So let's just kind of go ahead and kind of take a look at this, right? So obviously a dollar today is not the same as a dollar tomorrow, but I also want to use this opportunity to kind of show you to kind of prove to you about the present value of a dollar, right? Kind of concept. So if I go through and look at this, right, it's basically going to be paying 250,000 each year, basically for the next 4 years. And we know that a dollar today is not the same as a dollar tomorrow, but this is to be due on 12/31/22, 12/31/23, 12/31/24, and then 12/31/25. So when I look at this here, right, how do I go through and present value this? Well, I'm just going to kind of go through and do this for you and kind of show you how the annuity thing works. So if this is being paid, if I'm valuing this on 1/1/22, to value this $250,000, right? Obviously, we can say, okay, it's an annuity. I can take 250,000 present value of an ordinary annuity of a dollar and say 4 periods or the number of times interest is being paid at 8%. So I could just come over here, present value of an annuity a dollar, 4 periods at 8% is 3.31213. I bring this back over here, and the value of this amount is going to be 828,000. But what if I was to use instead the present value of a dollar table? Well, if I was to go through and use this, this would be present value of a dollar, one period at 8% because it's being paid 1 year from now. This would be present value of a dollar, two periods at 8%, present value of a dollar, three periods at 8%, and then lastly, present value of a dollar, four periods at 8%. So if I come over here and I said 0.92593, 0.85734, 0.79383, and 0.73503, right? I'm just coming over here, number of periods going to the 8%, and that looks correct. So if I just took these over here and I then kind of say, all right, if I multiply these out, 250 times 0.92593, and if I add all these amounts up, I get to the same value. So this is why it's a lot easier for us to use the present value of an annuity if the payments are going to be the same every single year. So what this tells us is that the equipment that we're going through and buying is not in fact worth 800 not worth $1 million. Rather, it's going to be 828,033. So on 1/1/22, I'm going to record the equipment basically at the fair value, not really the fair value, but at the discounted amount of those future installments at that market rate of interest. So here, my equipment is going to be valued at 828,033. But at the same time, what I also need to kind of remember is like, well, basically for this equipment, I'm going to have my notes payable. My notes payable is going to be $1 million. So what the difference between these is going to be my discount on notes payable. My discount on notes payable is going to be 171,968. Okay. Now, when it comes over here, okay, so we record the equipment basically because again, a dollar today is not the same as a dollar tomorrow. And this is how I'm going to go through and do it. Now, what's interesting about this is that, what would my balance sheet presentation look like on this particular day? Well, I would have my notes basically on my balance sheet as of 1/1/22, right? I'm going to have liabilities. And under my liabilities, I have to bifurcate it. I got to say, what's my current liability? And then what is my non-current liability? Okay, and I'm kind of actually glad I went through and did this. I'm not going to do this for all of them, but at least for this right now, what I'm going to kind of try to do is say, well, the amount of so for my current liability in the next year, right, I'm going to have a note payable current, and this is going to be 250,000. Then I'm also going to have over here a note payable non-current of 750,000. Now, why am I splitting it up like this? Well, by definition, current means it's owed within the next year operating cycle. So therefore, I'm going to basically say, well, I'm going to owe 250 grand in the next year. So I'm going to put this up here. And then for my non-current the portion of my non-current liability, I'm going to put the rest of that as non-current because that's going to be due on 23, 24, 25, which is more than 1 year out. Now, when it comes to the discount, but if I'm looking at this, right, this is $1 million, right? And that's not really what this is really going to be worth. So over here, I'm going to have, say, like less discount on notes payable. And for this one, I'm going to basically say, well, what's the value of this 250,000 1 year from now? Well, if I took 231,483 multiplied by 8%, I get 18,519, which is going to give me the 250,000. So less my discount on notes payable, I'll say it's 18,519. And then the rest of it or over here, 171,968 less the 18,519 is going to give me 153,449. Now, if you're asking me, well, Bennett, why did you go through and do this? Because if we didn't include the discount, right, what would kind of happen is I would end up overstating my liabilities, right? Because my liability is really the value of that note is really 828,032 or 33. Okay. So that's kind of how we want to kind of go through and look at this, right? So let's do this a little bit cleaner. Okay. Okay, it's closer. Okay. So coming right over here, but this is how we would go through and show on the balance sheet. If you're taking my class, I'm not going to make you go through and do this computation, but it was something during the lecture that I wanted to kind of go through and further clarify on. But what do we need to do? Well, we need to go through and do a few things. We're going to need to record depreciation expense, and we're using straight line, 6 years, no salvage value. How do we do that? It's going to be my acquisition cost minus my salvage value divided by my estimated useful life. My acquisition cost of the equipment is going to be 828,033. It has a zero salvage value. My estimated useful life is 6 years. So my annual depreciation expense is going to be $138,005. How do I go through and record depreciation expense? Well, it's one of those things that we're going to kind of be doing the same thing over and over again. And by the way, if you're watching this video and you kind of say, hey man, I'm like not in your class, but I want to see like, okay, can you show me like how you do the depreciation expense? Just leave a comment. I do have a lot of intermediate accounting videos for your reference. So just feel free to basically leave a comment below and then I can point you to the right direction. I am working on something in Canvas and I'll be able to make open to possibly to subscribers or to those who join like some sort of, I don't know, like not a cult, but something, I don't know. But in any event, let's go ahead and do this over here. So on 12/31/22 and beyond, right, I'm going to be debiting depreciation expense. I record that expenses are recorded with debits. And then over here, I'm going to credit accumulated depreciation equipment. Accumulated depreciation on equipment is a contra asset account. It reduces the carrying value of that equipment. So over here, this is going to be 138.5, and then this is going to be over here. So this is going to be literally be the same journal entry every single year. So there you go. That's the depreciation. That was one of the things that was being asked over here. So we did the purchase and we did the depreciation, but now what I want to do with you is let's go through and look at the next couple of years. We're not going to look at the balance sheet presentation, but I want to look at what happens every single year. Okay, so coming over here on 12/31/22, 12/31/22, 12/31/23, 12/31/23, 12/31/24, and then 12/31/25. One of the things that's happening is that on each of these different dates, right, we know that two things are happening. We're going to be debiting notes payable and we're going to be crediting cash. And this is going to be for 250,000 every single year, right? So this journal entry here is never going to change, right? So this is basically never, this entry, we've got to pay 250 grand. Okay. Now, the harder thing to do is that, as we've kind of said before, is like, well, when something is discounted like this, what exactly is this? Well, this is a, contra-liability account, but really what it represents is that this discount on notes payable, right? This discount on notes payable of 171,968 is ultimately, right? Obviously, this is reducing the carrying value of the note payable. Right. And this note's payable, as we just kind of saw, well, we're going to hit this for 250. This is going to go down to zero, right? But for this discount on notes payable, right, there's no such thing as free money. And so what this really represents is our interest expense. And so what we're going to do is we want this discount on notes payable to go down to zero. So ultimately, we're going to be going through and amortizing this 171,968 to interest expense. That's what's going to happen. So over here, we know that our journal entry is going to basically be, well, I'm debiting interest expense, right? Just similar to depreciation. I'm going to basically record those expenses with debits, and then I'm going to be crediting discount on notes payable. Now, the trickier part kind of comes in is with regards like, well, how much am I going to be going through and reporting on this discount on notes payable? Now, if I were to use what we call straight line amortization, right? I could just take 171,968, divide this by 4, and I get 42,992, and I'm done with the question. That's not fun. What is fun is doing things using the effective interest method, and especially on a question like this, which is a little bit more nastier than the other one we were looking at. So my discount on notes payable right over here is 171,968. And I'm making other videos on the effective interest method for discount on bonds payable. So I'm hoping that you'll check those out a little bit later on. But as we're going through and doing this, how do we go through and calculate this? Well, what we're going to do here first, we're going to say, it's like, what is our note payable carrying value? Right. So what is the carrying value of the note payable? So if we get to 12/31/22, my note payable carrying value is going to be my notes payable minus the 171,968, or 1 million minus 172,000. Okay. Now, what I want to do here to determine my interest expense, my market rate of interest, it was 8%. So I'm going to take this, multiply it by the market interest rate, and this is going to give me my interest expense of 66,243. So I'm going to go ahead and debit interest expense for 66,243, credit discount on notes payable. So right over here, crediting the discount on notes payable, right? And this is going to be as of 12/31/22. Also at the same time on 12/31/22, I'm reducing my notes payable balance by this payment right over here. So at the end of the year, my balances over here are basically going to be 750,000 if it helps you, right? This is basically going to be cash right over here. My cash basically coming out is 250. And then over here for the discount on notes payable, this is really going to be going through and basically impacting, we've got over here our interest expense. Now remember, with expenses, revenues, and dividends, these are being closed out every single year to retain earnings. These are temporary accounts, right? So this is going to be 66,243. But this discount on notes payable is what we call a contra-liability account, and it's going to basically carry over basically with the note. So as we look at this over here, right? So we basically have this is essentially the journal entry that we just did right up here, but in T account form. By the way, you're going to see me use T accounts a lot of times, especially when it comes to debt and like doing things on this, because if you know the T accounts really well, that can help you with the journal entries, right? Like ER, DC, AELOE. I've seen or I've heard from my students that, that have used this countless times, but on the CPA exam, especially like if you're doing things like statement of cash flows, if you're not using T accounts, it's probably not going to end up well. So let's go ahead and go ahead to the next year. So on 1/1/23, my value of my discount on notes payable is going to be 105,725. And the ending balance on notes payable, this was at 12/31/22, my new ending balance is going to be 750,000. So on 1/1/23, I've got 750,000 right here. So now if I kind of do the same like equation basically for the current year for 12/31/23, my note payable carrying value is going to be my note payable less my discount. So this is going to be 750K minus 105,000. My market interest rate is never going to change. It's always going to be that same amount. And my interest expense here is 51,542. Now you might be saying, well, why is the interest less? Is because, well, there's less debt that's owed, right? I'm going through and I'm basically paying this down every single year. And so over here, I would be crediting discount on notes payable for 151,542. I'm also going through over here and I'm paying down this note payable. So at the end of the year on 12/31/23, the note payable has a balance of 500,000 and my discount on notes payable as of 12/31/23 now has a balance of 54,183. The discount on notes payable is a holding account for interest expense and we're eventually going to go through and recognize. So this will have a debit balance, right? So other kind of important thing to consider is that as we're kind of looking at the balance sheet, right, this is as of 1/1/22, if I'm looking at just not including the funky, like the funky monkey, so this is really 1/1/22, 1/1/22. After I make that note payable payment on 12/31/22, right? So after 12/31/22, well, I've got 750,000 owed. Now, how does this work? Well, 750,000 is owed. 250,000 will be due 1 year from now on December 31st, 2023. But then only 500,000 is remaining, right? That's the amount that's basically going to be remaining after this period of time, right? So that's where we're kind of like going with this. Okay. So, and similarly over here at 12/31/24, you're still, it's me 12/31/23, you would still have $250,000 that's due in the coming year, but this non-current liability is going to keep on being reduced, right? Because as we continue to pay this down, the less amount of money we owe, and then finally getting to 12/31/24, which we'll be at shortly, there'll be no more non-current liability because this is going to be paid off within the coming year. So let's kind of move down over here to this next, let's go ahead and go down to this next phase. Let's go ahead and do the next period. So right over here. Okay, so my discount on notes payable, the ending balance for 1 year becomes the beginning balance for the following year. So 1/1/24, 12/31/24. Okay, so my discount on notes payable is going to be 54,183. My notes payable balance had a balance of 500,000, right? So, and basically over here, my interest expense, okay, so doing this computation right here for 12/31/24, my note payable carrying value is basically going to be prior to the payoff is going to be 500,000 minus 54,183 or 445,817. Okay. My market interest rate is at 8%. So my interest expense is going to be $35,000. Okay. So that's kind of how we go through and look at this. So now going through and looking at this again, the interest rate is dropping. Let's go ahead and add these other ones in. So again, the interest is getting lower every single year, which kind of makes sense because we're continuing to pay down this note payable. Okay, so essentially over here for the final year of going through and doing this, and I'm just going to go ahead and copy this down over here. The discount on notes payable is going to be 18,518. This is going to be 1/1/25, 12/31/25. Basically over here, I've got 1/1/25, 12/31/25. Okay, so my very last period of time, right over here, my note payable carrying value is going to be 250,000 minus 18.5 thousand. So my interest expense is going to be 18,519, rounded down to 18,518. And then I've done what I'm supposed to do. The discount went down to zero when this thing is being paid off, right? And so over here, my very last entry is going to be a debit to interest expense of 18,518 and basically a credit to the discount on notes payable. When you're going through and doing these questions on your own, I really want to encourage you to kind of, I'm overkill, right? Like what I'm doing here is like, this is not even being asked by the question, but I really want you to kind of understand is like, you've got to practice this out. The more you handwrite out, the way we learn accounting is basically by handwriting solutions. The more times we handwrite out the solutions, the better we're going to get it again. So hopefully this was helpful for you. I look forward to seeing you on future videos. Please feel free to leave any comments if you want me to kind of, if there's any other questions you want to go through and kind of take a look at. But thank you for watching. Please remember to like and subscribe and feel free to leave a comment or if you want to send me an email at ivc30tocpa@gmail.com. I would enjoy hearing from you. Have a great day and I look forward to seeing you on the next video.